Well, US markets are set to close lower today after falls in oil, copper and iron ore prices. Now we're joined by Mark Newton of Greywolf Execution. Mark, if we did see lower ongoing demand for commodities from China, to what extent might that temper gains in US markets?
Well, what's interesting is in the last 3 months, you've seen one of the bigger moves in commodities as you've seen in the last couple of years. I mean, commodities were in a cyclical bear market from 2011 in the spring, and recently we've seen, I think, sufficient signs of commodities bottoming out and moving higher to suggest that, there is no real slowdown in the commodities themselves. You'll still see a lot of the softs, a lot of the metals, showing good progress. A lot of the grains have started to show signs of bottoming out, and some of that's based on the Russia-Ukraine conflict. But we've gotten extended in a very short period of time. I don't know that China's slowdown necessarily means that commodities have to move lower and stocks move lower. The emerging market sell-off has more signs of contagion that could lead to sell-offs here.
Okay. Now, we've recently passed the anniversary for 5 years of a very strong bull market. While we are lower today, positive sentiment remains. At what point are we due for a correction?
Well, the fact that everybody's been asking that same question makes me a little skeptical that we're right there just yet. I do think that the market will correct at some point this year, probably between April and September. The second and third quarter historically is seasonally a good time to expect a correction. You still have the advanced decline that's right near highs, and at least historically you've never seen major market peaks, at least back in 2007 and 2000 when you saw the market still trading fairly well, and technically we're still in very good shape. Financials were the best performing sector over the last 5 days. That's certainly a tailwind for stocks. So despite the fact that we're down a little bit today, it's really premature to make too much of this correction just now.
Okay. Now, what do you see as the biggest risks to US stocks at the moment? Would it be fair to say that they're really geopolitical in nature, the Ukraine, China?
I think that's right, because we're already out of earnings for the most part. We've seen revenue shortfalls to some extent, but earnings have come in as expected and fairly decent. The geopolitical force could cause somewhat of a contagion, particularly with regards to emerging markets and how Russia acts with that. And we know that Russia and Ukraine really shows no signs of simmering down anytime soon. If anything, it probably is likely to escalate. My thinking is that Ukraine becomes equally as much of an issue this year as the Greek protests were probably 2 years ago, and as much as taper talk was on everybody's minds last year. So I think this is going to be an ongoing thing. Could that affect emerging markets further? They've already been hit pretty hard. So I think a lot of them are down near pretty good support. The Chinese market fell to new recent lows, the Shanghai Composite back under 2,000. I'm starting to see signs of some of these looking better to buy, but if the broader market sells off, it's tough to think that emerging markets are going to be the place to be, at least for the near term.
Okay, thank you, Mark. That was Mark Newton of Greywolf Execution, and I'm Jane Searle for The Street.